Welcome back and thanks for staying with us. And joining us at this point is Deven Choksey, Managing Director at DR Choksey FinServ, to talk to us about how he's viewing markets and what he's viewing in terms of a trend. Good afternoon, Deven. Deven, let me first start off with the standout of the day, which is the IT pack. It's done very well last week. It continues to do well today. Now, I know you wouldn't look at this on a daily basis, but do you believe that the worst is behind us, at least where the IT pack is concerned? And within that pack, would you prefer the larger caps or would you prefer the mid-small cap stocks?
So good afternoon, Harsh. Well, I guess I think a couple of points. The large IT companies, Infosys, TCS included, have shown the character of adapting to the change and change for better, I believe. I think we've been talking about this subject for some time now. Up till now, I think these companies have been operating the asset-light model. Today, I think the TCS has shown the path by way of, I think, going ahead with the investing into the asset-heavy model in the sense that capex model, as we call it as. They're putting across the data center end of a JV, and that's where probably I think the beginning of new era should be seen started for many of the large IT companies. The coding part of the business, I think, under the AI is definitely going to take a new shape, new birth, I believe. And these companies have accordingly, I think, made the proper adjustment within their setup. They're creating the new platforms wherein the AI-based application development activity would happen over a period of time. At the same time, I think they've started investing money into the product-based, the platform-based approach. And in my viewpoint, I think that's fundamental. These companies are generating cash. They are having significant large amount of cash. On the contrary, every 2 years, 3 years, they pay it back by way of buybacks, etc. So in my viewpoint, I think the right strategy to go. And given that kind of a format in which the companies are adapting today, we believe that the worst definitely seems to be behind them. Once US starts showing larger amount of clarity on the tariff front, in my viewpoint, I think the re-rating for these companies is possible. And 15 to 20% kind of an upside in stock price from the base level, I think is distinctly possible in some of the companies' cases. So we remain selectively bullish, as we said before as well.
Very interesting you say that because you're sounding extremely positive, IT. You're obviously you're not going to give me bottom-up names, but give me a sense, give me a tilt. Do you tilt towards the larger cap IT players, the more traditional ones who are making these investments? Because the ROCs will differ on the fresh capex that they're doing. So how do you view that? Or would you look at the mid and the small cap who are a slightly more agile in that sense and are able to adapt to AI faster than some of the larger cap names?
It's a mix of both, I believe.
Okay.
I think the large cap companies definitely hold the advantage today because the valuation wise, they are not expensive. Some of the mid-tier companies who are B2B player catering to their OEM partners, I think they are definitely slightly more expensive compared to them. But nonetheless, I think both of them are offering a good amount of clarity. The mid-tier IT companies are purely driven by the solution-based approach. The large cap companies are purely driven by infrastructure-based growth approach. So certainly, I think both of them are showing a different character. In my viewpoint, I think selectively you have to include both. Large cap companies in the near term could possibly hold an edge because I think they would give better return. They underperform, they are relatively cheap comparatively. So they can probably give better return. Mid-tier IT companies may take a while, I think, to start participating in the market. So I would think that I think it's a combination of both on a selective basis.
Perfect. Kunal, do you have a view or a preference, large versus mid-small within the IT pack? Also, in particular, Tech Mahindra standing out 2.5% in trade today.
Yeah, I think today is a day where Tech Mahindra is standing out. Earlier it was the likes of HCL Tech, which is doing very well. Infosys today also I think had done reasonably well. So I think the move is getting spread across many of the stocks within the IT pack. Not just looking at one stock which is leading the charge from the front, but that's a positive. Because ideally when you see the move trickling to say second, third, fourth kind of price performers, then we expect that these are the kind of stocks which will also have their fair share of, say, when the IT index starts to get into an outperforming zone. The only underperforming stocks within the IT pack so far, when we look at the price scale on the larger cap front, are the likes of TCS and Wipro on a relative basis with respect to their previous highs, the distance between the 200 moving averages for the stock and the current market price, etc. So on many of the matrices over here, we are looking at these few larger cap names which are underperforming. So I believe that as of now, one should concentrate on very few select large cap IT names, HCL Tech, Infosys, something which you've been highlighting earlier, as well as Tech Mahindra. Mid cap IT wise, I still believe Persistent and COFORGE are the top two names purely in terms of the price trends.
Okay, so that's where your tilt in IT is. Kunal, your pick for this afternoon?
So to buy calls, I would still suggest at current levels, as we were discussing earlier, that the financial services pocket is looking attractive. So would look out for L&T Finance as one of the interesting picks over here. The stock showing a classic outperformance today, trading about 290 levels. So would look out for targets in the range of 299, stop loss at 290. And the second would be a ban FSN, Nika. I think that's a stock which has been showing signs of a classical breakout. It's almost like a bullish flag formation on the daily charts. The stock breaking the levels of 267, 268, which is the previous swing high. So would look out for targets in the range of 278 and stop us at 267.
Okay, what we'll do is we'll slip into a very short break. We'll continue our conversation on the other side with both Deven as well as Kunal. Stay Ruchit Jain, Vice President, Equity, Technical Research, Wealth Management at Motilal Oswal Financial Services. Deven, let me come to you first before I go to Ruchit for a technical call. What's the take like with regard to Realty? We've seen the index come off the highs. There's obviously pressure. Execution is obviously something which is now the big focus area for most companies. But debt is low and therefore the risk per se seems inherently low. Prices are sustaining. How should one play Realty in this market?
Well, I think in my viewpoint, one will have to keep in mind two aspects. The first aspect, given the strong demand scenario, I think we are not seeing, I think, too much of a stress as far as I think the sector per se is concerned, and housing market doing reasonably well, including in tier 2, tier 3 cities. So certainly, I think that's a good point. In my viewpoint, I think across the board, one will not be able to take a call. But I would think that given the kind of opportunity that we see in the luxury and ultra luxury segment, that's where possibly I think the better realization come better profits along with better ROC is being seen in some of the companies' cases. Now, if some dedicated developers who are basically following this particular approach, they would be certainly better off, likes of Sri Lotus developers. Maybe I think some of the others, Loda and the Oberoi, they are possibly I think selectively having these pockets as well, apart from having the mass market also at the same time. So in my viewpoint, I think we'll have to be selectively going into this particular space.
Okay, and Deven, the one key trend that stood out for you in the Q2 FY26 commentary as well as numbers, a sector, a space, company which you feel really stood out and which you are not anticipating or expecting?
So, well, I think we have been following few things, and I'm glad that the cost factor is coming down across the board for most of the companies, including in the chemical companies, the commodity companies as well. I believe that chemical commodity as well as metal commodity, they remain relatively more promising given the kind of valuation, given the kind of growth that they're assuming. So we certainly believe that I think the trend is upward in this area, in this sector, and that's where possibly one would like to see higher amount of growth going forward in subsequent part of the financial year. Selectively though, I think not completely buying everything out, but selective companies are definitely showing better performance, particularly those APIs and CDMO ones. I think where the business is regular and at the same time, I think the cost factor is down. I think they're relatively at a better place in chemical sector.
Ruchit, anything in Realty that you're liking?
Well, I think at least from a short-term perspective, the sectoral trend seems negative. Now, recently, we have seen that the markets had rallied higher. It was mainly supported by major other sectors, such as banking, to an extent, IT and others. But Realty was one of the sectors which did not participate even when the Nifty was going higher. So, considering that the sector has been an underperformer when the markets were going up, now we are seeing a broader market correction, and that's where we can see selling pressure coming in. So from a trading perspective, at least we are advising to avoid such underperforming sector, and we could see some more price-wise correction before the sector bottoms out.
Okay. And Ruchit, your call on the Nifty and the Nifty Bank in terms of levels, what are you penciling in for this week?
So there's a clear divergence which has been seen on the Nifty benchmark index and the broader markets. Since last few days, we are consistently witnessing a negative market breadth. And even if you look at the returns on the benchmark versus the small cap, the Nifty in this calendar month of November is up by 1.5%. Bank Nifty is up by 1.7, 1.8%. But small cap index is down by 4%. So you can see the huge gap is there, where the Nifty is being held on by some of the key heavyweights, but the broader markets are witnessing a sharp sell-off. And the Nifty small cap index also, if you see, then the index has breached its 200 DMA support. On previously in last 2 or 3 months, the small cap index, whenever it used to correct, 3 times the index had taken support around its 200 DMA and resumed its uptrend, but this time it has been broken. So we believe that in the short term, markets would continue to see such divergence where we won't see any significant price-wise correction in the Nifty, but 25,800 where 20 DMA is there, that would be the important near-term support. We could see some dip towards those levels, but not expecting any great trended phase on the Nifty in the near term. But yes, the small caps as well as the mid caps, I think that's where some price-wise downside or correction could continue.
Do you believe that broader markets still look pricier relatively, and would you be cautious in that pocket? Or do you believe now valuations have become much more fair, and how do you view the Nifty 50 pack within that metric in terms of valuations? Where do you think that one sits? Deven, that one's for you, please.
Sorry, I missed that question.
No problem. It's with regard to how you're looking at valuations right now. We're on 26K on the Nifty. How at this juncture, how do you see valuations, possible earnings upsides going forward in terms of growth? And second is on the broader market end, where we've not seen much movement. In fact, where we've only seen more pressure. How do you see valuations there? Do you believe that we are fair now in terms of valuations, or do you still believe that we're slightly overvalued?
So as of now, I think we are fair as far as the valuation is concerned. Growth trajectory is higher, so that's a good comforting factor. In the second half of the financial year, along with the higher top line, we are likely to see, I think, the lower cost structure in operation, and that's where possibly the results are going to be showing better performance, and that's where the valuations are not looking too expensive, so they are fairly valued. The broader market remains convincing, except I think the small and mid caps. Small and mid caps have had the run. Probably, I think they're valued, I think, at FY28 levels today in most of the cases. So, frankly, I think I would not be very gung-ho about buying them into the portfolio. So, the Nifty 50 per se, or even in selectively Nifty 500 within that, I think some of the stocks are offering good opportunity at fair valuation today.
Very interesting again. Kunal, your take with a couple of names. One is a City Union Bank, which is perked up nearly 3.5+%. Also, an NBCC is doing fairly well in trade. View on both of these after the kind of move we've seen?
Yeah, I think City Union Bank is a classical case of a massive turnaround. I remember, I think the stock when it had broken 220 mark, I think a month and a half out back, and from there started off a massive zone of outperformance for City Union Bank, and then that too at a point where when the large cap private sector banking stocks were still grossly underperforming. So this comes as a bit of a positive surprise. The trend is positive for City Union Bank. The last 3 days prior to today's move, the stock had seen a mild correction from 280 levels to 260 thereabouts, and now from 260 the stock is back to 270, 272 plus kind of a zone. So which means 260 is a good support for the stock in the near term, and on the higher side we are looking at 280, 282 as an immediate target for the stock. For the other name which you mentioned, which is the other stock?
NBCC.
Yeah, NBCC. NBCC was a zone of a breakout about 118, 119 mark. The stock today is showing the most the highest volumes in the last, I think, 3 to 4 months for trading, and that too with at a point where the stock had a touch and go towards the 118, 119 breakout on the spot level. So I'll wait for maybe one leg of confirmation over here. Once the prices cross that 119 mark, then we can attribute that today's volume is not just an intraday trading volume for NBCC, but more of delivery volume with the stock trading closer to a breakout of 119 levels. So just wait above 119 mark and then trigger a buy.
Deven, currently in terms of sector, what's the most attractive to you that you're finding?
Honestly, I think more than sectors, we find deep value proposition in some of the large cap companies, if I may say so. I guess I think the unlocking of valuations is going to be the next theme which might get played out in next 6 to 12 months time. And that's where probably I think some of the group companies from Reliance or maybe Adani's or even Tata's for that matter could possibly show a better amount of participation by the players in the market. The sector per se, though at Universal will not buy everything, but some of the metal commodity companies are looking really interesting. They are showing the good signs of growth from current levels. Other side, I think their input cost, the energy cost, is I think remaining on a control level, lower level. Also because of the fact that I think the blended energy cost is coming down for them due to the captive renewable power that they are bringing in. So in my viewpoint, I think some amount of weight should go towards the commodity segment. Within that, I think the ferrous, non-ferrous metal would be, I think, a good choice. Along with, I think, as I said, some unlocking value proposition, which is happening in large cap companies, where we see the growth is going to be probably smarter compared to the others.
Deven, give us your view with regard to some of the new age tech companies, some of the quick commerce companies, etc. There's a new labor code which has come through. Does that in any form change your opinion, or do you believe that some of these look interesting? Basket approach, better approach in this case. What's the take? Which side of the fence do you sit on?
They are expensive. I think labor code's not changing the course for most of these companies. And I think they remain expensive proposition at this point of time. Unless we see a meaningful amount of contribution in form of beating the benchmark yield, that is the treasury yield. I don't think that I think those companies are becoming anywhere nearer to, I think, buying lists as far as our portfolios are concerned. I think the market has overpriced them, possibly because the rush to include those stocks into their portfolio, given the top line that they are reporting and recording. In my viewpoint, I think won't be in a hurry. Maybe I think you will see the sideways to down movement in some of the cases. And that's where probably I think in corrective market downside would be the better approach at such point of time to play out. Immediately not in rush to buy any of the consumer companies. Rather, as a consumer, we would like to use the tech for advantage of consumer spending.
Excellent. Thank you so much, Deven, for coming in and speaking with us. We'll let you go on that note.